Hello and welcome to the second video on this channel. Today, we're tackling a topic that should concern us all, especially during these times of an imminent global crisis: how to invest your money. We'll discuss the main ways to invest your money and the best practices that, over decades, can drastically change your financial standing. Let's make this clear. In this video, I won't be telling you to invest in specific companies or indexes. The goal is to understand the principle behind each type of investment, along with their advantages and disadvantages. Why investing your money is so important. First of all, investing your money wisely is crucial. With high inflation expected to rise further across the Western world, money that just sits idle is money that loses value. For example, imagine you had $100,000 in your bank account in 2000. By today's standards, that same money would need to be worth $183,000 to maintain its value, adjusting for inflation. In other words, starting with $100,000 in 2000, it's as if your money had lost nearly 45% of its value over 25 years. The first goal of investing isn't necessarily to become rich, but to protect your wealth against inflation. There are several popular investment options: stocks, stock market indices, real estate, cryptocurrencies, stable commodities like gold or platinum. Depending on where you live and your bank's offerings, you might also benefit from high-interest savings accounts. Before diving into the specifics of each type of investment, let's take a moment to discuss how you could allocate your budget to invest your money safely. Remember, investing is a long-term process that can involve losses. You must stay patient and informed to ensure financial security and minimize risks. Structuring your budget. Let's say you earn $50,000 a year. The first step is to separate your essential living expenses, housing, food, and your discretionary income, which allows you to enjoy life and invest. From that $50,000, let's assume $20,000 goes toward housing and related expenses, and $10,000 is spent on food. That leaves you with $20,000 of free money per year, money over which you have real control. Next, you'll need to divide that $20,000 into what you'll allocate for leisure, vacations, etc. This step can be tricky because we often underestimate how much we spend on things like a casual beer here, a restaurant there. Let's assume you end up with $10,000 left to invest each year or to keep in a savings account. The final step: investing. First and foremost, it's a good idea to ensure you have a safety net saved in a stable account. Many experts recommend having 3 to 6 months' worth of salary set aside to provide financial security. Next, before investing in any asset, focus on paying off any debts you may have. Doing so guarantees a return on your money since debt payments are unavoidable anyway. To summarize, separate your budget to determine how much you can invest. Make sure you have sufficient reserves. Pay off debts before investing elsewhere. The investments. Understand the options and make the right choices. Now that we've covered the importance of structuring your budget, let's move on to the main types of investments available as well as their pros and cons. Keep in mind that each option suits different profiles depending on your goals, risk tolerance, and investment horizon. 1. Stocks. Stocks represent shares in a company. When you buy a stock, you become a partial owner of that company, entitling you to a share of its profits via dividends and/or growth in your investment if the company succeeds. Advantages: potentially high long-term returns, often 7 to 10% annually on average. Participation in the success of innovative and thriving companies. Flexibility: you can buy and sell stocks relatively easily. Disadvantages: high risks, as stock values can plummet during economic crises or poor performance. Requires time to understand businesses and markets. A critical point about stocks: avoid trading. When you invest in a company, adopt a long-term perspective. Quick buy and sell strategies often lead to significant losses. Moreover, studies have shown that stock indices outperform 90% of actively managed funds over the long term. So, don't waste your time and money with day trading. When you purchase a stock, aim for a holding period of at least 2 years, ideally longer. 2. Stock market indices. Indices like the S&P 500 or CAC 40 group together a selection of stocks representing a market or sector. Investing in an index via ETFs, exchange-traded funds, is a simple, effective way to diversify your investments. Advantages: lower management fees compared to traditional funds. Automatic diversification: you're not betting everything on a single company. Stable and predictable long-term returns, about 7 to 8% annually for the S&P 500. Disadvantages: lower returns compared to the most successful individual stocks. Exposed to general market fluctuations during crises. Cap 3. Real estate. Investing in real estate, whether residential or commercial, remains a go-to strategy for many. This can include buying physical properties or investing in real estate companies through REITs, real estate investment trusts. Advantages: passive income through rental payments, long-term appreciation of property value, a tangible asset that you can use or sell in times of need. Disadvantages: high initial costs, down payments, notary fees, low liquidity, selling a property can take time, risks associated with tenants or fluctuations in the real estate market. 4. Cryptocurrencies. Cryptocurrencies like Bitcoin and Ethereum are controversial but increasingly popular. These digital assets operate on blockchain technology, and their value depends on supply and demand. Advantages: huge potential for short-term gains. Some investors have seen returns of several 100%. Decentralization: no control from governments or central banks. Easy access through online trading platforms. Disadvantages: extremely volatile. Losses can be as quick as gains. Limited regulation, which can lead to risks of fraud or hacking. Not suitable for cautious or beginner investors. 5. Commodities. Gold, silver, platinum. Physical assets like gold are considered safe havens. They protect against inflation and economic uncertainty. Advantages: security during crises or monetary instability. Easily traded worldwide. Value preserved over centuries. Disadvantages: little to no long-term yield, no dividends or growth like stocks. Storage and insurance costs, prone to price fluctuations in the markets. 6. Interest-bearing investments. These include savings accounts, government bonds, and other interest-paying accounts. While less exciting, they offer stability. Advantages: low risk, ideal for cautious investors. High liquidity for certain products, like savings accounts. Great for building an emergency fund. Disadvantages: low returns, often below inflation. Not suitable for significantly growing your capital. Diversification, the key to success. The secret to successful investing is diversification. Don't put all your eggs in one basket. For instance, you could allocate 40% to stock indices for long-term growth. Invest 20% in real estate to generate passive income. Keep 20% in secure investments or liquid assets. Reserve 10% for commodities to protect your wealth. Dedicate 10% to riskier investments like cryptocurrencies if you're comfortable with the risk. This allocation is just a general example and should be tailored to your goals, age, and risk tolerance. The best investment: yourself. Finally, don't overlook one last investment: yourself. Whether it's starting your own business, learning new skills, or expanding your network, investing in yourself is often the most rewarding. Most fortunes are built through entrepreneurship, so why not you? On this channel, I'll share tips and motivate you to start your own venture. Thank you for watching this video. Don't forget to subscribe and like if you enjoyed it. Also, share your investment experiences in the comments. Let me know what you think about this video format. It's only my second one. Take care and see you next time.